Good evening. Today we have to start from the adjustment to the venture capital method in regard the incentive ownership. So I have already told you that the most of the ventures they have this equity component in their employee compensation. So this equity component in their employee compensation identified as the incentive ownership. So normally for startup companies, they have two main reasons to have such kind of an incentive ownership scheme. One is that they can pay lower compensation now. Therefore, the need of external financing is low. And the second reason is impact on the motivation of employees because the employees and the founders will share the same goal to increase the value of the venture because at the exit time point employees will also receive shares, therefore they will they will share a common goal of increasing the value of the equity. So therefore normally ventures have this incentive ownership. So this is like employee share option schemes, right? And as I have told you, every time the loss of ownership should be bared by the founder, right? So here also, if there is any incentive ownership scheme in the venture, the loss of ownership should be bared by the founder. So we move on to the example. So here the founder has agreed to set aside 6% of shares at the exit time for incentive compensation. So that means uh, the original founder from his ownership he is giving up again 6% for the incentive ownership. So normally this percentage is agreed upon at the beginning of the venture or it can agreed upon when doing the venture at the midway as well. But normally it happens at these agreements happens at the founding, the beginning of the venture. And I hope you all have remembered that after the second round financing, the original owner has only 8.4375% of ownership. So out of his 8.43% of ownership, now he is giving up 6% ownership. So ultimately, he will have only 2.4375% of shares. And these shares will be distributed through a stock plan and are expected to generate 200,000 rupees in exercise proceeds. When the options are exercised at the end of the year 5, that means at the exit time, assume the use of these 200,000 in proceeding has been already included in the projected earnings. That means when we are projecting the earnings, we have considered these proceedings that will be generated at the end of the uh, period. That means at the exit time. So we need to calculate as earlier the first round, second round and incentive ownership round, the share ownership percentage. Since we have done a similar type of question, I have already prepared answers. So I will quickly go through the answers. Right. So at the first, we need to calculate the original owners, the ownership percentage. So as I mentioned earlier, after the second round financing, the founder has only 8.4375% of ownership and now he is giving up again 6% ownership for this incentive ownership scheme. So he is remaining with 2.4375% ownership. And he already has 2 million shares. Now this 2 million shares represent only 2.43% of the ownership. Therefore, we can calculate the total number of shares by dividing this 2 million shares by this 2.43%. So the total number of shares you can calculate it as 82 million. It will be 82 million 51,222 shares. The total shares after the incentive round. Then we can recalculate the first round, the number of shares issued for the first owner, the first round owner, that means first round owner. So out of this total 82,051,202 shares, the first round investor owns, his entitlement is 75.9375% of ownership. So 82 million multiplied by this 75.9% of ownership is equal to 62,307,692 shares. So at the first round investor owned roughly 62 million shares. And the share price we can recalculate. So the first round investor is willing to invest 1 million shares. 1 million rupees. So 1 million rupees divided by the total number of shares received by the first round owner, which is 62 million. So 1 million divided by approximately 62 million, you will receive the value as 0.01604 rupees. And then you know how to calculate the pre-money value and the post-money value. So pre-money value is calculated by getting the per share price multiplied by the number of shares before the first round of financing. So the original owner has 2 million shares. So the per share value multiplied by 2 million, the original owner's number of shares equals to the pre-money value, which is 32,099. Then the post-money value is equal to per share value. Original investors number of shares 2 million plus the first round investors number of shares 62 million. So altogether after the first round, this venture will have roughly 64 million shares. So the post money value is equal to 1,32,099, and the founder's ownership percentage between the first round and the second round we can calculate by dividing his number of shares, which is 2 million, by the total number of shares after the first round financing, which is roughly 64 million. So the founder's ownership percentage after the first round is equal to 3.11%, and the first round investors ownership percentage between the first and the second round we can calculate by taking the first round investors total number of shares, which is 62 million, divided by the total number of shares after the first round financing, which is 64 million. So that would give you 96.89% of ownership. Then moving on to the second round financing. So at the second round, so the shares issued for the second round owner is equal to the total number of shares, which is 82 million, multiplied by the second round investor needs 15,625% of ownership of the venture. So therefore 82 million multiplied by this 15.625 ownership percentage equals to 12.82 million shares. So the per share price for the second round investor we can calculate. Second round investor is also willing to invest 1 million rupees for the venture. So this 1 million divided by the number of shares received by the second round owner, which is 12.82 million shares. So 1 million divided by the 12.82 million shares is equal to 0.078 rupees. So now we can calculate the pre-money and the post-money value at the second round of financing. So the pre-money value is equal to, so before the second round financing, we have roughly 64 million shares. So 64 million shares multiplied by the current share price, which is 0.078, is equal to 5.016 million rupees. So that is the pre-money value. And then the post-money value. So after the second round financing, and in addition to the first round 64 million shares, now we have 12.89 shares for the second round investor as well. So we have to add the both numbers and multiply it by the current share price, which is 0.78. So we'll give you 6.016 rupees million rupees of post money value. And the founder's ownership percentage between the first, second and the third round we can calculate. So he has 2 million shares divided by the total number of shares after the second round financing, which is roughly 77 million, so 2.59%. And then the first round investors ownership percentage between the second and the third round investment. So 62,307,692. The 62 million shares are the number of shares owned by the first round investor divided by the total number of shares after the second round financing, which gives us the 80.78% of ownership for the first round investor. Then for the second round investors ownership percentage, we can calculate by taking the second round investors number of shares. Number of shares belongs to the second round investor, which is 12 million, divided by the total number of shares after the second round investment, which is 77 million. So you will come up with 16.6223% of ownership percentage. So finally, we will be moving on to the incentive ownership round. So in incentive ownership round, shares issued for the employees is equal to 82 million shares into 6%, which is equal to roughly 4.92 million shares. Then we can recalculate the founder's ownership percentage after the incentive issue. So this round is the final round of financing. Therefore, after adjusting the value for this incentive ownership, we should come up with the ownership percentage values for the first round, second round, and employees. So for the first round investors, you can see the 62 million divided by the 82 million, we will come up with 75.937% of ownership. For the second round investor also, he entitled for 15.625% of ownership. So we can check whether he is receiving that amount because if we divide the 12.82 million by the total number of shares after the incentive ownership round, which is 82 million, you will come up with the exact values. So I go through these calculations quickly because we have already done this part in the classroom. So finally, the venture value, the venture valuation pie will reflect like this. So the founder owns only 2.4%. The first round investor will own 75.93%. Second round investor will own 15.62%. And the incentive ownership round, therefore the employees will own 6%. So the new part of the lesson is introducing scenarios to the venture capital shortcut methods. So that means up to now we have considered only one exit value. We have only considered one terminal value. Okay? So as long as firm is in a very stable state or the economic and environmental conditions are stable, then having only one exit value, only one terminal value can be acceptable. But it is better to know, it is better to estimate what will happen to the venture in different scenarios. So in entrepreneurial finance, we can identify three main scenarios of for ventures. One is called black hole. So black hole means venture results in 100% loss, like no light. So there is no possibility of obtaining gains. So they will have losses, therefore they will quickly exit from the venture. And the second scenario is living dead. So that means venture only provides the break-even earnings for several years. So they cannot exceed the break-even uh, earnings to earn profits. Therefore, they provide the minimal return for the investors. So venture that provides the minimal return for its investors, or the venture that is barely surviving, is called the living dead. And then the venture utopia, this is the idealized scenario where the venture becomes very successful and earn a good returns. So widely successful ventures is considered under this scenario, so venture utopia. So up to now, we have done our the venture capital valuation based on this success scenario, based on this venture utopia. Right, because we have made the estimations of cash flows and estimate values based on the business plan and and based on the assumption of success. Right, therefore we have done all our valuation under this venture capital shortcuts under this considering this venture utopia scenario. Right, so so the cash flows and discounting factors that we have used up to now is also reflect this venture utopia. So normally the cash flows estimated under this success assumption is called utopia cash flows, and the discounting factor that we used to discount those cash flows is called utopia rates. So this approach of only considering the success scenario is called utopian approach. But we know that it reflects a very idealized scenario. Therefore, it is better to use an alternative approach to this valuation. So the alternative approach to this utopian approach is called mean approach. So the alternative approach to this utopian approach is called mean approach, where we consider all these three scenarios and get the average values of earnings and the exit values in calculating the value and the ownership percentage of the firm. So we will discuss this through an example. So I will give you a couple of minutes. Could you quickly read the next question? someone is considering an investment of 1 million rupees in a new technology venture, and the potential venture investors believe that venture has 20% chance of being a black hole, 60% chance of becoming living dead, and 20% chance of achieving venture utopia. So after careful investigation, venture investors project that under the black hole scenario, it as a total loss in third year liquidation, so there will be no gain, and after 3 years, company will exit. And the living dead scenario projected 200,000 rupees in earnings starting from year 5 and price earning ratio of 7 for the 7th year exit. That means under the living dead scenario, company will exit at year 7 and the exit value is equal to 1.4 million, and they will start earnings in year 5, which is equal to 200,000. And the venture utopia scenario is 2 million in earnings starting from year 2 and the price earning ratio of 20 for the 5th year exit. So therefore the exit value is equal to 40 million. So under utopian scenario, they will exit at the end of year 5 with exit value of 40 million, and they will start earnings right after year 2. So the earning per year is equal to 2 million. And then now this investor is willing to invest 1 million rupees. So 1 million rupees investment entitles that yearly dividend payment of 2,000 rupees only if venture has earnings. So if venture has earnings, this investor has entitled the dividend payment of 2,000 rupees. And someone, the investor, expects 22% of return for his investment. So you are required to calculate the acquired percentage of final ownership by someone. Right. So let's see how we do the calculations on this three scenario mean flow approach. So now we know black hole, living dead and utopia are the three scenarios. So black hole, the percentage, the chance of being a black hole is 20%, 60% living dead and 20% chance of utopia. So probability is 0.2, living dead 0.6 and utopia again 0.2. And if it is black hole, then no cash flows, and at the end of the third year, the firm will exit. If it is living dead, then they will generate cash flow starting from year 5 and they will exit at the end of the 7th year, and exit value is 1.4 million. So at the beginning, no earnings. So first time they will generate 200,000 rupees for at the 5th year, but you should know that 200,000 is not entitled for this investor, right? That is the total earnings. The entitlement is only the dividend amount, which is 2,000 rupees when venture has earnings, right? So under the living dead scenario, venture has earnings in the 5th year. If so, the investor is entitled to 2,000 rupees of dividend. So year 5, he will have 2,000 rupees of dividend. Year 6 again 2,000. Year 7 also he will receive dividend of 2,000 plus the exit value. So here the exit value is 1.4 million. So this investor is not entitled to this entire 1.4 million. So this should be multiplied by his ownership percentage, which we doesn't know. Therefore, we will use a symbol to reflect. Let's use gamma to reflect the ownership percentage. So the exit value multiplied by the ownership percentage will belong to the investor. Right? And if we consider the utopian scenario, the venture utopia, the 2 millions in earnings starting from year 2, and they will exit at year 5. So 40,000 exit value, right? So if venture has earnings starting from year 2, the investor is entitled 200 2,000 rupees of dividend for his 1 million investment. So he will receive 2,000 rupees of dividends until year 5. Until year 5 plus the 40 million exit value multiplied by his ownership percentage. Multiplied by his ownership percentage. Right. Now you have to calculate the mean cash flows of these 3 scenarios. So year 1 there is no cash flow. Year 2, 2000 multiplied by the probability 2000 into 0.2, which is equal to 400. Right? So likewise calculate the mean value of those cash flows. So for year 3 also, you will have 2000 multiplied by the probability of 0.2, 400. Here also 400. And now here, this 2000 should be multiplied by 0.6. So therefore, 2000 multiplied by 0.6 is equal to 1200 plus this 2000 is multiplied by 0.2, so which is equal to 400 plus this 40 million multiplied by 0.2 is equal to 8 million, right? 8 million multiplied by the ownership percentage. And this 2000 multiplied by 0.6, which is 1200. And again, this 2000 should be multiplied by 0.6, the probability, 1200 plus 1.4 million multiplied by 0.6, which is equal to 840,000 into the ownership percentage. Now this column, this row shows the mean cash flows, the average cash flows under the 3 scenarios. Now how do we calculate the ownership percentage? So we know that the required rate of return of this for this investor is 22%, right? So the present value of all these cash flows should be equal to the initial investment value, right? So he is investing 1 million rupees today, and the present value of his future cash flows under the return of 22% should be equal to his initial investment of 1 million, right? So we can build up a formula, right? We can use an equation. So his initial investment is 1 million, right? 1 million is equal to the present value of all these cash flows. We know we have 1, 2, 3, 4, 5, 6 cash flows. So the first cash flow 400,000. The discounting factor is 1 plus. The required rate of return is 22%. To the power, first cash flow occurs at the end of the second year, right? Therefore, to the power 2. So likewise, you can discount all these cash flows. So can you all discount these cash flows and tell me what is the ownership percentage? That means finally you have to solve the equation to get this unknown variable of gamma. So 1 plus 22% to the power 3. Again at the end of the fourth year also we have a mean cash flow of 400 rupees. So 1 plus 22% to the power 4. Then at the end of year 5 we have 1200 plus 400. So we can add these two, so 1600 plus 8 million. Into the unknown variable gamma divided by 1 plus 22% to the power 5. Then again 1200 plus 22% power 6. Then finally 1200 plus 840,000 into gamma divided by 1 plus 22% to power 7. So use for calculators to get the unknown variable and tell me what is the ownership percentage is entitled for this 1 million rupees by this investor. You can give me the answer through the chat. I hope you all can see the equation. Only one student has read me the answer. What happens to others? You'll just have to solve this formula for the unknown value. So the ownership percentage is equal to 30. Yes, is equal to roughly 31.5%. To be exact value is 31.496%. So it's okay, 31.5%. Right. So now I have given you a practice question. I think this is not in your slide set. So get a screenshot and attempt on your own. I will give you 5 minutes. So here the investor is willing to invest 5 million rupees in this venture, and he wants to decide what is the final percentage of ownership that he needs for in exchange of this 5 million investment, and his required rate of return is 25%. And the probabilities of the scenarios are given: the complete failure 20%, the living dead 50%, and the venture utopia 30%. And under the living debt scenario, venture will exit at the year 5 with 10 million exit value, while the exit value at year 5 would be 50 million under the venture utopian scenario. So under both scenarios, this venture will exit at year 5. If it is living debt, then the exit value would be 10 million. And if it is venture utopia, the exit value would be 50 million. In addition to this exit value, there will be an annual 1 million preferred dividends to be paid to the investor under the venture utopia scenario for each 5 years. So starting from the year 1 to year 5, the investor will receive 1 million preferred dividends under the success scenario for the exchange of this investment. So no preferred annual cash flows are expected under either black hole or for the living debt scenario. So there will be no cash flows under the black hole or living debt scenario. So determine the acquired percentage of final ownership. Right. So if we move on, now we know what is the probability of the black hole scenario. What is the probability of black hole scenario? 0.2, right? 0.2, and for the living dead 0.5, and venture utopia 0.3, right? And no cash flows under the black hole scenario, and the living dead also there will be no intermediate cash flows, but the exit value would equal to exit value would equal to 10 million, right? So the exit value would equal to 10 million rupees. This should be multiplied by the ownership percentage which is reflected by the gamma. Then under the utopian scenario, there will be preferred dividend of 1 million each year, right? 1 million each year. 1 million each year for every year. Plus year 5, the exit value of the firm is equal to 50 million under the utopian scenario. This value is equal to 50 million. Now it is equal to 50 million. Now you can calculate the average value of the mean cash flow of these three scenarios. 1 million multiplied by 0.3 probability for all these years. It should be 300,000. Here, apart from this 300,000 plus 50,000, sorry, 50 million into 0.3, which will be equal to 15 million, right? 50 million into 0.3 probability, it will be equal to 15 million. multiplied by the ownership percentage plus under the living death scenario, the exit value will be 10 million. So 10 million into the probability of 0.5, that will give you 5 million. Right? So 5 million multiplied by the ownership percentage. Now you can equate the present value of all these cash flows to the initial investment of 5 million to obtain the final percentage of ownership. We know the required rate of return of the investor is 25%. So the initial investment 5 million rupees. What is the present value of all these cash flows? Discounting factor is 1.25. So 1 plus 25% to the power 1. Likewise, we can discount this. The final year, we have apart from this 300,000, 15 million into plus the 5 million. The final answer is final ownership percentage is equal to is the percentage of ownership. The percentage of ownership is equal to 63.98%. 63.98%. 63.98%.